Hello everyone, my name is John Paul, DayTradeToWin.com, and today I'm going to show you and teach you an actual method to forecast the year 2021 as we move forward throughout the month of January. Before we begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose, and talk to your broker and understand the risks involved with trading. So today is January 8th and the market is beginning to move up and move higher. It doesn't mean that this is where the market's going to go in relationship to January, but if it does continue higher and move throughout the month, a higher close when February comes around, you can consider that a good bullish opportunity to be a buyer throughout the year. You can be a swing trader, you can be a day trader, but it will give us a good validation that the year will close higher than where it opened. So to give you an example, we'll go back to last year and we'll do 2019 as well. I'll give you lots of examples on what I'm showing you. So for right now, we have to wait until January closes in order to be a predictor of where the market's going to go. And then we'll look at rules, how to enter, how to manage the trades, what kind of targets, what kind of stops, all those good things you guys want to learn. So here we have January of 2020, this past year, and what you're seeing is the market closing higher and starting in February much higher than where it opened. So I'm looking at a higher closing month. And when you have this higher closing month, this indicates with about 90% accuracy that the year itself will be a bullish year. Not necessarily it's just going to continue up and up and up, but at the end of the year, you should see the market higher than where it closed. So how do we approach this as traders, swing traders, day traders? How can we take advantage of this? Well, there's two ways that you can take advantage of this. The first way, my recommendation, is to wait until we have a substantial pullback, usually 3, 4, 5 days at minimum, where we can say, okay, the market has made new highs and now it's retracing and returning to a level where traders are going to find this to be an opportunity and to be a buyer. That by itself is the first way that we look at this as at least a 4 or 5 day retracement. And once that occurs, from the highest high to the lowest low, we put this 50% retracement on the chart and we wait until the market breaks that 50% retracement back up to test the highs where the market has been. So as the market is starting to go lower and lower and lower and lower and lower, I'm using this 50% retracement to tell me when and where and how and at what price to go long. So as soon as the market breaks 50% marker, whether it be a day trade, whether it be a swing trade, whether it's just an opportunity to be in the market at a good price with validation, we're long. Now, when you do go long, obviously I don't want the market to come back down, but if it does, you should have stops and you should get out of the market. We don't want to risk a huge amount of money. You have to let it breathe a little bit. Obviously, you can see that the market was a little bit sideways, but the goal is to say we finally made a move that we're returning back to test the highs. Markets love to test where they've traded. Markets love to test where the highs or lows have been. And so this is an opportunity at a specific price. Probably let it go a few points, or let it you see a day that closes above. It's a good opportunity to say I'm long. You can use the Atlas line, you can use the trade scalper, you can use any method that you want to validate this as a day trader, as a swing trader, but you have an opportunity to be a buyer. That's the first way that we look at this. And into the future, every time the market makes new highs here, it usually has a pop. In the past, this is called a stochastic pop. It's more technical in nature, and it's not something that I go into during the teachings at DayTradeToWin, but typically when the market breaks the highs, it pops, and you have another opportunity to be a buyer as the market breaks the highs. Once again, we start all over we have the market retracing at least 4 or 5 days, something significant that you could see the market's retracing and pulling back. And what do? We place this retracement of 50% once again here to go long only after the market breaks the midpoint, breaks this 50% marker, or has a closing day. So not yet. And there it is right there. Now you have an opportunity to go long, be a buyer, and the market wants to test these highs where it has just previously traded. And once again, once it does break the highs, it does a pop, makes the pop, normal price action situation that you're seeing here, nothing spectacular. Now, when you look at the previous year, 2019, if you want to look at another example, 2 or 3 years in a row, and I want you to look back and test this yourself and learn this, because it's a very good way to predict the year. And every time you have an opportunity to go long, if it in fact the January effect is clear, you have this opportunity. So once again, as soon as the market in February realizes that it's a higher close and open, each time we have a retracement, here's a small retracement here, at least 4 or 5 days, you're long and it pops. Again, this may be a smaller retracement here. It breaks and pops. The same thing is true here, where you see the market retracing big. What happens when it breaks? It tests the high, and not only does it test the high, it also pops. So you can see that this is a way that you can forecast specific ways to enter into the market throughout the year. Lastly, let's talk about the profit target. The profit targets depend on what type of volatility at the moment when you enter. So as you know, I have hundreds of videos out there where I explain and show you the reason why I use this little known indicator, the ATR, the average true range. I use a setting of 4, last 4 days, last 4 minutes, last 5 minutes, last 4 hours, whatever you want to call it. It's the setting of 4. And the idea is, for example, when you do enter long, let's say that you decide to go long when it breaks the highs, look down here. This is about a 23, 24 point move. And how do I know that move was made? I can put up my ruler, and the market went more than 23 points. The same thing is true when you decide to go long. Look at the ATR. This is 36 points. Market went more than 36 points. So you can have a good idea of what type of target you want to use, and then you can trail a stop. You can shoot for the highs. You can begin to unload if you have multiple contracts. There's so much you can do to manage the trade. But really the idea is the entries. If you enter correctly and you manage the trade, you should be fine using this method. If you have any questions, email me through the website, DayTradeToWin.com. There's a Contact Us page. The next mentorship class begins January 19th, 2021. If you have any questions, visit the website for the details. Thank you and have a great day. If you're new to day trading and want to learn more on the benefits of trading the markets, visit DayTradeToWin.com. Join the next mentorship class starting later this month, and subscribe to the DayTradeToWin YouTube channel. We focus on price action and work exclusively with new and beginner traders who want to learn more on how to prosper from trading.